go ahead and get going here this morning. Just wanted to give a little bit more time. We had 30 or 40 people signed up, so just wanted to see if everybody's having trouble logging in or not. But we're going to go ahead and get going here. Don't want to take up too much of your day. So, hi, everybody, and thanks for joining us today for this webinar. I'm Jake Stazik, the president of Corpay Retirement Services, which is Corporate Payroll Services Retirement Wing. Before we jump in, I want to sincerely thank all of you, all of our customers for joining us today. You're really a key part of today's economy and the small business. So for you to carve out time with us, especially during this COVID time, we really appreciate your time and your business. So today I'm excited to talk about our Safe Harbor 401k plan, which we primarily use with an administrator called PAI, or Plan Administrators Inc. A little bit of background on them. PAI focuses on the same market that we have focused on for nearly 30 years, so small businesses. PAI is probably among the most competitive, cost competitive providers in the retirement industry, yet still provides a very high level of service. They're independent, which helps us cost-wise because we're not being directed to use certain funds or other certain insurance products, and that helps minimize fees as well. But it also means that they can focus more on you and you as the customer. Lastly, PAI's hands-on approach to customer service, it closely resembles our approach, both with the time frame and kind of the one-on-one kind of hometown feel. So as you can see, this partnership has made great sense for us over the years, and I think it's going to continue to make sense in the future. So really excited to go over our safe harbor plan and how it works with PAI. So we have a few things that we'll cover today. Towards the beginning, it'll just be a little bit on the retirement industry, discuss how 401k benefits you, and then we'll chat about the benefits of a safe harbor. We'll close with the Copilot 401k service, which is PAI's kind of flagship program, and really how this partnership with PAI and Corpay Retirement Services will work for you. So most people think about retirement as something that's far into the future. The reality is that you can't put it off. By making small, regular investments when you are younger, your savings will grow tax-free throughout your working career. You're losing money every single day that you wait to start investing. When examining a few key principles, we can often relate them back to having a 401k and the benefits of saving early on. As you can see in this chart, for example, the two contestants within the savings pattern are the amount of the investment and the annual expected rate of return of 7%. The difference lies in the starting age and the years of savings. This may seem obvious, but the later you start, the less time you have to save. So the difference in the results are dramatic. A 25-year-old will have a much higher balance than a 55-year-old, almost $1 million compared to $69,000. That is significant. Additionally, the money grows tax deferred. Compounding happens year over year, which can be significant. Tax-free growth allows them for greater wealth accumulation and helps reduce taxable income today. So basically, this chart breaks down, if you're saving $5,000 a year, making 7% a year, if you had started saving at 25 versus 35 versus 45 and 55, it's a huge difference. And to save smaller amounts when you're younger and keep them at smaller amounts rather than having to pack in a bunch towards the end of your retirement or towards the end of your working career, closer to your retirement, can make a big difference, and it can help alleviate a lot of strain that would be felt later on. All of us have heard about the issues facing Social Security in the news and during every political campaign season. Social Security was never really meant to be the sole source of retirement income for Americans. It was originally designed to supplement your own savings or pension. As a result, people are relying too heavily on Social Security retirees, and they may need to work longer than anticipated, so work past 65, 70, even 75. And it's also been predicted that Americans will need about $250,000 in savings just to cover medical expenses in retirement. But it's closer to $400,000 if you include pocket costs like deductibles and other insurance premiums. And so, with the cost of health insurance just always increasing, it seems like, that has to be part of your retirement plan as well, because many people are needing more and more health care for a longer period of time, which is a good thing because people are living longer, but it costs money to live longer as well. So it's really risky just to rely solely on Social Security for retirement. Like likewise, you as a business owner, you can't always count on just selling your business to fund your retirement, because things do change and businesses do change over time. And so, if you're planning on selling your business to fund your retirement in 10 years, it may not be worth what you think it'll be worth 10 years from now. So it's always good to have some sort of backup plan, in the form of some sort of cash investments, like a 401k. So sometimes people say the only thing certain is change, and business owners are continually evolving their businesses to stay competitive in the market. The retirement industry is also continuing to evolve. I'd like to just briefly touch on a few major initiatives that are happening in the industry that'll impact you mainly in a good way. So the DOL fiduciary rule was a rule that was implemented during the Obama era and was actually canceled out by the Trump administration. But a lot of changes occurred in the industry because of that fiduciary rule, and most of them have stuck around, even though the rule has been essentially canceled by the new administration. As a plan sponsor, you are the retirement plan's fiduciary and ultimately hold liability in the plan. One of the plan sponsor's most important responsibilities is the selection of investment options offered in the plan. The headlines were continuing to highlight lawsuits about excessive fees and choosing funds that underperform the market. And part of what has changed over the years is trying to limit the exposure that a plan sponsor has on that side of things. And so not every plan sponsor is going to know what investments everybody needs in the plan. And so basically what we have is called a 338 service with the Copilot 401k. A 338 takes that liability away from the plan sponsor and pulls it onto themselves. And so basically, it minimizes the liability of the investment choices and offers you a layer of fiduciary protection that you just wouldn't have in a regular 401k plan without that 338 aspect. And that is something that's becoming very common these days, because employers don't want to be responsible for the investment selection in the plan. That's what you pay advisors for. The next initiative I'd like to take a look at is the state-initiated Roth IRA plans. As we talked about, Americans aren't saving enough for retirement, and Social Security shouldn't be the main source of retirement income. So some individual states are seeing this red flag and are offering state-initiated retirement solutions. This means business owners may be forced to offer a retirement program to their employees in the next couple of years. One of the major states that we have an office in is Illinois, for instance, and they do have a state program that is required once you have a certain number of employees. And the real problem with that is that it becomes an administrative nightmare for the employer, because basically you have to have the employees sign up or you have to have them opt out. They they physically have to opt out using a form that gets turned back in so that the employee is opted out of the program. If not, what will happen is you'll have to set up a certain deduction. There's a minimum enrollment, and then you have to transmit that money to the state plan. And we can help out getting that money to the state plan, but it becomes quite the nightmare when you're trying to put everything together. And the states just aren't thinking about the administrative side of things when they're implementing these. And so hopefully there's some different changes, and a little bit more successful types of plans that are initiated. But it looks like Illinois and Oregon and California were kind of the first ones to do that. Other states have plans, but they really haven't been implemented at this point. So let's dive into the benefits of specifically of 401k. There are many benefits that a plan sponsor can receive when they offer a 401k. First and foremost, it's going to help them prepare for their own retirement. So many business owners are caught up in making their business successful, and they forget to handle their retirement planning as well. So this will help out with that. Second, there are many company tax benefits to offering a 401k plan. There's a new tax credit that you can get. So if you're establishing a plan for the first time, your company can receive a 3-year tax credit for $500 or $250 per eligible employee up to $5,000. And so you can receive some tax credits that will more than cover the administrative costs of the plan. And any employer contributions made to employees, such as a match, is deducted on the company's federal income tax return and not subject to FICA. Lastly, and certainly not least, having a plan attracts and retains talent and helps employees save for their retirement. In fact, in their annual study of employee trends, MetLife found that retirement benefits was ranked second as the most important benefit their employer can provide, followed by or preceded by health coverage. And so, with the high cost of employee turnover, the average employee turnover costs $10,000 to the employer. A 401k plan provides an affordable benefit to keep employees around. So how does a 401k plan compare to other types of retirement plans that are offered to employers as well? The 401k has the highest maximum deferral limit for employees. In the 401k column, in the simple IRA column, you can see that there is an employee deferral portion of it. And you can see that the 401k has the highest both employee deferral and catch up. So it's going to have the most amount of money that you can put in the plan. There's also going to be a couple of different design options that are in the plan with the 401k. Unlike the simple IRA is going to be a little bit more stringent on the ability for you to design the plan, so it's going to be kind of bare bones. A Sep IRA is going to be strictly employer funded, and that typically is not appealing to employers that have several employees. Typically a Sep IRA is used by a sole proprietor that is just contributing to their own, not one where you'd have it with a bunch of employees. And so 401k is going to provide the highest amount of contributions, the most flexibility, and the most plan design options as well. So let's talk specifically about the safe harbor plan, because that is what is coming up here. We do have a deadline for safe harbor plans for 2020 of September 18th. And so if there is any questions or anything like that, just go ahead and type them in the chat, because this is where it's going to get into the details for plans specific to this time of year. So there are 4 main rules an employer needs to be aware of when it comes to a 401k plan, among a few other items. The first one's being eligibility. This means that an employer can limit the plan to certain employees based on tenure of work and hours worked. You cannot limit the plan based on part-time or full-time. It's going to be based on how long they've worked for you and how many hours they've worked in that time frame. So for example, the maximum allowable time frame that you can keep an employee out would be 12 months of service and 1,000 hours in that 12 months. So this helps keep most of your part-time employees from becoming eligible. Obviously, this can be adjusted lower to include more employees. You can also make it so that they have to be 21 years of age. So if you own a sandwich shop or something where you have a lot of high school help, you can limit it so that those employees would not become eligible for the 401k plan. It's not something that they're probably going to take advantage of at that age anyways, but it does help keep your employee count down in that, so that your full-time and your management staff are the ones that are receiving the benefit. The entry date is once an employee reaches eligibility when they can enter the plan. You can choose to have a semi-annual entry, so it'd be January 1st, July 1st. You could have a quarterly entry, you could have a monthly entry, or you could have an immediate entry into the plan. So basically, you can have the eligibility rules when they become eligible and then when they're allowed to enter in the plan. A lot of employers, once they become eligible, will just allow them to enter the plan immediately, since they've already reached, it could be a 12-month period of time that they've been waiting. If you have a semi-annual and an employee becomes eligible January 2nd, they wouldn't be able to participate in the plan until July 1st. So a lot of times that's immediate, but it's completely up to the employer to determine that. Let me just ignore that real quick. The other piece here would be vesting. Vesting is basically determines how much of a match or profit share that you've given to an employee they would walk away with if they left your company. So you can essentially claw back some of your match dollars if an employee were to leave, which can help them stay around longer. And these timeframes can be as long as 6 years before they'd be fully walking away with all of their match. Um, but for the most part, it's usually not that long, because then it kind of gets a little bit too long for the employee, and then that's not a benefit that they see as a soon enough benefit for them. But you can make that decision and extend out that. The one that's highlighted here is the discrimination rules. And it's highlighted because this is something that you cannot control. And so if you are not offering a 401k plan, or a safe harbor 401k plan, and you're just offering a traditional 401k plan, you would be subject to these discrimination testing rules. And basically, these discrimination testing rules, there's two of them to be concerned about. The first one is called the top heavy test. And basically, we look at the plan as of December 31st, and we say, okay, owners and key employees, which would be like officers in the company, people who make $150,000 or more, or have small ownership in the company. Um, the owners and key employees cannot own more than 60% of the plan assets as of December 31st at the end of the year. If the owners and key employees own more than 60% of the plan assets, the plan would fail top heavy, which means they basically would be given the next year to correct that. So hopefully you get enough employees to contribute to the plan that you get under that 60%. But if you continue to be at that 60%, what's going to happen is you're going to be forced to give the employees a contribution of 3% of their pay, even if you've never had a match set up. And so a lot of times we see plans come over that all of a sudden these owners are being told that they have to give this contribution to employees because they were never explained how this top heavy test works. And so that's something to be concerned about when you are not offering a safe harbor 401k plan. The other one would be an Adp Acp test, which is the average deferral percentage, average contribution percentage testing. Owners and highly compensated employees, which is not actually the same set of employees as owners and key employees, because this is going to be owners and people who make over $125,000, can only defer a certain percentage of their pay based on what every other eligible employee is doing. And so if the average employee deferral and every employee that's eligible that's not contributing counts as zero. So this usually ends up being pretty low. But if you take the average of all the rank and file employees and put it together, and their average deferral is 0 to 2%, the owners and highly compensated employees can only do 2 times that amount. If it's between 2 and 8%, they can do 2% plus that average amount. If it's over 8%, they can do 1.25 times that average. If the employer has done more than that, if so at the end of the year, obviously we don't know what the employee's average is until December 31st for that year. What will happen is the employer will receive a check back that will be taxable. It won't be penalized, but it'll be taxable to them, that will get them down to within the acceptable range. And so there's these two tests combined. Not only could you get a check back at the end of the year because you fail ADP or ACP, but you could be forced to give the employees a contribution as well. So employers are like, Jake, this is way too much. How do I just avoid this? I don't want to have to deal with this. That sounds way too complicated. I really don't want to deal with that. So that would be why an employer would set up a safe harbor 401k plan. And basically, it's pretty easy to satisfy a safe harbor 401k plan. And once you satisfy that safe harbor, you are exempt from those two tests that we just talked about. So you either have to offer a 4% match, which is probably the most common way that an employer goes about it, because an employee has to be participating, and they have to be participating at a certain level in order to receive that 4% match. The other option would be to do a 3% non-elective contribution, which basically means you give 3% to the employees no matter what, no matter if they are participating in the plan or not. They just have to be eligible and they get the 3%. They don't even have to put a single dime of their own money in. That's the lesser common way, although we do have some employers that do set it up that way. Your eligibility can be no longer than 12 months and 1,000 hours. So you can't be longer than that time frame for employees to be eligible for the plan. You can still do 21 years of age. You can still do, anything lesser than that, but these are the most strict that you can be. And the match is immediately vested. So you lose the ability to reclaim some of that money if an employee leaves. Once they receive that match, they have received that match. And so that is how you satisfy a safe harbor plan. And especially in the small business aspect of things, when it comes to year-end work and those testing and everything, it's really not something that you want to be worrying about. And so the safe harbor really alleviates a lot of stress and just helps plans just flow and stay steady rather than going back and having these issues to deal with at the end of the year. So let's talk about pricing. So pricing for the 401k with PAI has a one-time setup fee of $390. There's a base administrative fee of $100, and that's no matter how many employees you have. There is a payroll integration fee that's charged by corporate payroll services of $15. So if you are a semi-monthly payroll, you'd be looking at about $130 a month in total admin costs. Now, remember the tax credit that we talked about where you can receive $500 or $250 per employee. You can also receive another $500 if you have auto enrollment on the plan. So it gets pretty easy to get the cost covered with the new tax credits that are out there. Another optional service that we have, this is not something that you have to include in the plan, but an optional service that we have is a 316 administration. And basically the 316 administration is we take care of doing all the year-end work for you and then file your 5,500 for you. So at the end of the year, even if you're a safe harbor plan, you still have to submit the year-end test work, which basically will just come back saying that you've passed, and then they will give you your 5,500 to file. We will take care of all of that if you add the 316 service. Some companies want that because they just are like, Jake, I don't want to deal with anything. Just go ahead. You take care of everything. We'll get it taken. We'll get it all set up and going. Some companies are like, Jake, we can do that. That's totally fine. It's not that big of a deal. So totally optional service there, but basically $100 per month flat, $15 per payroll fee. That's it for the employer. So the employer doesn't cover any other costs of the plan from that point on there. The employee fees, employees' accounts, now these are charged to the employee accounts. They're not billed to the employees, but they're charged to their accounts once they have a balance. So they pay $4 a month or $48 a year, basically in an account maintenance fee, which is the record keeping fee. And then their annual asset-based fee is 1.32%. This does drop down 0.5% once the plan total assets get to 250,000. But since this is mostly for new plans and startup plans, that would be the fee for a new plan right there, the 1.32%, which that's divided up monthly and pulled from their accounts on a prorated basis. So participants also receive some useful tools. They're tracked and notified when an important life event has taken place, like a pay raise or change in contributions that will impact them on their road to retirement. So they do receive these alerts that are automatically sent to them just to make sure that they're being reminded of their 401k and making sure that they are keeping up with it. Also, they do have the option of having a more personalized service. So whether they have $100,000 in a balance or $0 in a balance, they'll always be able to schedule a 30 to 60 minute one-on-one with a licensed advisor. And so, we find those meetings to be more successful in helping employees than just a general enrollment meeting, which we can also provide. However, we like to have those one-on-ones with employees just to make sure that they are, being helped on a more personal level so that it's something that's actually going to work for them. So with that, then I will go ahead and open it up to any questions, anything that anybody would have. Go ahead and type it in the chat, or I can unmute everybody. Sometimes It's a little loud, but I'll try that too as well, just in case anybody has any questions.
Hello.
So I will go ahead and look for questions in the chat. But I will say some of the common questions are, how long does it take to get this started? Basically, we're looking at anywhere from 2 to 4 weeks to have a plan fully up and running. Depends on, how quickly we can have meetings together and how quickly we can get everything designed and put into the plan. But it's pretty painless to get going. Just a few things through DocuSign, and then everything else is done online. Another one is, I still get the question about part-time versus full-time employees. And so when you're looking at eligibility, you got to be looking at hours worked and how long they've worked for you. So an employee who works 20 hours a week will eventually become eligible because they'll hit 1,000 hours in a year. So even your half-time employees will eventually become eligible, but like I said, you can keep them out for at least 12 months if you have it set up that way. So are there any other questions that anybody has? I'm going to go ahead and put my contact information up on the screen here. So if you want to get moving or want to learn more about the Safe Harbor 401k, it's best for us just to have a one-on-one call so that we could tailor something that's more personalized to your business. My direct line here is extension 7115, so 770-446-7289. If you call me, generally throughout the day, I'm available. If not, if I'm on the other line, just leave me a voicemail and I will call you as soon as I get back, done out of that meeting. Also my email is there as well. So, if there is any questions that you have, go ahead and email me and I'll be happy to answer them as well. We are looking at a deadline of getting these set up. Now this is set up by September 18th. And so if we have paperwork back earlier in that week and we can work things really quickly, we can have it set up by then, but we want to make sure that, we're giving ourselves time to set up the plan correctly for you. So if there are any more questions, just feel free to type it in the chat. We will be following up with an email with this meeting as well. So any other questions? Otherwise, I'm right at a half hour here, so I do want to allow you guys to get back to your workday. And I appreciate you all coming. Thank you.